Financial statements are essentially the report cards for a company, outlining its financial performance and condition to stakeholders. They are indispensable tools for investors, managers and financial analysts, providing a numeric representation of a company's operations. These documents help in making informed investment, lending and management decisions. Understanding these statements is crucial for anyone looking to delve into the financial aspects of a business, irrespective of their financial background. The four primary financial statements each serve a unique purpose and offer different insights into the company's financial health. They include the income statement, retained earnings statement, balance sheet, and cash flow statement. Each of these documents provides essential data that, when combined, provide a comprehensive overview of a company's financial standing. In simple terms, these statements tell us if a company is making money, how much it is keeping, what it owns versus what it owes, and how it spends and receives cash. Grasping the basics of these financial statements can demystify financial data and make it accessible to beginners. This essay will break down each statement, explaining its importance, structure, and some key terms with examples to make the concepts clear. By the end of this discussion, you should have a foundational understanding of how to read and interpret these vital financial documents, equipping you with the knowledge to make more informed decisions, whether you are investing in, managing, or simply interested in a business. The income statement, also known as the profit and loss statement, details a company's revenues and expenses over a specific period, typically a quarter or year. It starts with the total amount of money brought in from sales and then subtracts the costs involved in generating those revenues. The final figure, known as net income, shows what the company has earned or lost during the period. This statement is crucial as it provides a clear picture of a company's operational efficiency. Understanding the income statement is vital because it reveals the profitability of a company. It helps stakeholders determine if a company is capable of generating earnings relative to its sales, expenses, and other costs. For instance, a company with rising net income is generally viewed as successful, whereas one with frequent losses could be a warning sign of potential troubles. The basic structure of the income statement includes revenue, cost of goods sold, COGS, gross profit, operating expenses, and net income. For example, if a company sells $100,000 worth of goods and the cost of goods sold is $60,000, the gross profit would be $40,000. This simple calculation can provide immense insights into the company's operational performance. Key terms in the income statement include gross profit, which is the profit a company makes after deducting the costs associated with making and selling its products. This figure is crucial for assessing how efficiently a company uses its resources. Other important terms are operating expenses, the costs necessary to maintain the business's daily operations, such as salaries and rent. The retained earnings statement is a financial document that outlines the changes in retained earnings for a specific period. Retained earnings represent the portion of net income that is not distributed to shareholders as dividends, but is kept by the company to reinvest in its business or to pay debt. It is a critical indicator of a company's financial health and its potential for future growth. The importance of the retained earnings statement lies in its ability to show how a company uses its profits. It provides insights into the company's policy on dividend distribution and reinvestment strategies. For investors, understanding how a company manages its retained earnings is key to assessing its long-term growth potential and sustainability. This statement's basic structure begins with the retained earnings at the beginning of the period, adds the net income, and subtracts any dividends paid out during the period. For example, if a company starts the year with retained earnings of $10,000, makes a net income of $5,000 and pays out $2,000 in dividends, the retained earnings at the end of the year would be $13,000. Key terms here include dividends, which are portions of a company's earnings given back to shareholders. The management of these dividends, visible through the retained earnings statement, can indicate a company's maturity and confidence in its own financial stability. Section 4. Balance sheet. The balance sheet, or statement of financial position, provides a snapshot of a company's assets, liabilities, and equity at a specific point in time. It is formatted to show that a company's total assets are equal to the sum of its liabilities and shareholders' equity. This statement is crucial as it shows what the company owns and owes, offering insights into its financial stability and liquidity. Understanding the balance sheet is important because it reveals the company's capital structure and can help assess its ability to meet financial obligations and fund future growth. A strong balance sheet usually indicates a robust financial position, capable of weathering economic downturns and capitalizing on new opportunities. The basic structure of the balance sheet includes assets on one side and liabilities plus shareholders' equity on the other. For example, if a company has total assets of $100,000 and liabilities of $60,000, the shareholders' equity would be $40,000. This simple equation, assets equals liabilities plus equity, is fundamental in financial accounting. Key terms in the balance sheet include current assets, such as cash and inventory, which are expected to be converted to cash within a year, and long-term liabilities, such as mortgages or bonds, which are due after more than 1 year. Understanding these terms helps in analyzing a company's liquidity and long-term financial health. Section 5. Cash flow statement. The cash flow statement, unlike other financial statements, focuses solely on cash movements in and out of the business. It categorizes cash flow into 3 activities: operating, investing, and financing. This statement is essential as it provides stakeholders with a clear view of how a company's operations are generating cash, how it is being invested, and how the financing activities are being managed. Understanding the cash flow statement is crucial because it helps identify the actual cash being generated and used by a company, independent of the accounting methods affecting other financial statements. This insight is invaluable for assessing a company's liquidity, flexibility, and overall financial performance. For example, positive cash flow indicates that a company's liquid assets are increasing, enabling it to settle debts, reinvest in its business, and withstand financial challenges. The basic structure of the cash flow statement includes cash from operating activities, cash used in investing activities, and cash from financing activities. For instance, cash received from selling products would be listed under operating activities, cash used to buy a new plant under investing activities, and cash received from issuing new shares under financing activities. Key terms in the cash flow statement include cash from operations, which refers to the cash generated from the company's main business operations. It is a good indicator of whether a company can maintain and grow its operations. Another term is capital expenditures, the money spent on acquiring or upgrading physical assets such as equipment or property, which is crucial for assessing a company's investment in its future operations. Section 6. Conclusion. The understanding of financial statements is fundamental for anyone involved in business, whether they are investors, managers, or simply interested in understanding the financial dynamics of companies. These documents provide a wealth of information that can help in making informed decisions and assessing a company's financial health. The income statement shows profitability. The retained earnings statement highlights financial growth stability. The balance sheet provides a snapshot of financial positioning, and the cash flow statement reveals the liquidity and cash handling of the business. Together, these statements form a comprehensive picture of a company's financial health and are indispensable tools for financial analysis and decision-making. By familiarizing oneself with these financial statements, individuals can better understand the inner workings of a company, enabling them to make better investment choices, strategic decisions, and financial assessments. In conclusion, while financial statements may initially appear intimidating, a basic understanding of their structure, key terms, and the information they convey can demystify the process and open up a wealth of data for analysis. Hence, whether you are a budding entrepreneur, a potential investor, or simply a curious individual, grasping the essence of financial statements is crucial for navigating the complex world of business finance.